12 money rules that actually matter, and nobody taught you any of them. You've been handling money your whole adult life, but nobody sat you down and explained how it actually works. Not the mechanics, not the rules, not the traps that are quietly running in the background of every financial decision you actually make. And the result? Well, most people spend their entire lives working hard, earning, decent money, and somehow never quite getting ahead. Not because they're lazy or stupid, no, because they're playing a game that nobody fully explained to them. Today, I'm walking you through 12 money rules that actually matter. Not theory, not motivation, mechanics, the real ones. The ones that compound quietly in the background, whether you know about them or not. By the end of this, you'll see your financial life differently. Some of this will clarify things you already felt, but maybe couldn't name. Some will make you rethink decisions you thought were smart. All of them, all 12, are worth knowing. So let's go. Compound interest cuts both ways. The most powerful force in personal finance is working in your life right now. The question is which direction it's pointing. Compound interest is what turns a modest investment into real wealth over time. Put money in, it earns returns. Those returns earn more returns, and after 20, 30 years, the numbers look almost impossible. But the exact same mechanism runs on debt. A credit card balance at 20% annual interest, minimum payments only, you'll pay back nearly double of what you originally borrowed. The bank is compounding against you with the same mathematical force you could be compounding for yourself. Every financial decision you make is either putting compound interest to work for you or handing it to somebody else to use against you. Check which side you're on. A 20% loss needs a 25% gain just to break even. Losing 20% and gaining 20% is not the same thing. And the difference explains most investing mistakes. You invest 1,000 of whatever currency. It drops 20%, so you now have 800. To get back to 1,000, you don't need just 20% gain. You need 25% because you're not starting from a smaller base. The bigger the loss, the more extreme this asymmetry gets. A 50% loss requires a 100% gain to recover. A 75% loss requires 300%, 3 times more. This is why panic selling during a market crash is so devastating. You lock in the loss, miss the recovery, and need extraordinary gains just to get back to zero. Protecting what you have is not the same thing as being conservative. It's mathematics. Losses are harder to recover from than most people, at least intuitively, understand. Buy things that grow in value, lease things that don't. One principle applied consistently will change every major purchase decision you make for the rest of your life. A car loses roughly 20 to 30% of its value the moment you drive it off the lot. In 5 years, it's worth a fraction of what you paid. Owning the depreciation makes no financial sense. A property in a growing area holds value, generates rental income if you rent it, and appreciates over time. Owning that asset makes complete sense. The principle is simple. Buy things that are worth more tomorrow than today, or that generate returns today, and lease or rent things that lose value over time. And this applies to cars, equipment, technology, and almost any major purchase. Before you buy something, ask one question. Will this be worth more or less in 5 years? The answer tells you whether to own it or just to rent it. The subscription trap. You probably have no idea how much you're spending on subscriptions, and the number is almost certainly higher than you think. Streaming services, software, apps, gym memberships, cloud storage, news sites, delivery passes, that one thing that you signed up for some years ago and you forgot about it. Each one feels small. 10 euros here, 15 there, 20 somewhere else. But subscriptions are specifically designed to feel invisible. One small enough to never trigger a conscious spending decision. Recurring enough to add up to something significant. Add them all up. Actually do it. Most people who do this exercise find they're spending an equivalent of a car payment sometimes every month on things they barely use. And the fix is simple. Once a year or once a month, audit every recurring charge. Cancel anything you haven't actually used in the last 30 days. The money you recover costs you nothing. $100 today is worth more than $100 in a year. So get paid early and pay late. Every payment has a hidden time dimension that most people completely ignore, and it's costing them money. €100 today is worth more than €100 in 12 months. Not because of greed, because of inflation and opportunity cost, and the simple fact that money available now can be put to work immediately now. This means two things in practice. When you're owed money, invoice early, follow up fast, push for upfront payments when you can. Every day someone else holds your money is a day it's working for them instead of for you. When you owe somebody money, pay on the last possible, legally possible day before the penalty, not the first day you can. Keep that money in your account, generating returns for as long as legitimately possible. Same amounts, different timing, different outcome. This is treasury management, and it applies to individuals as much as corporations. Never take financial advice from someone earning commission on what they recommend. The person giving you financial advice is almost always being paid by someone who benefits from what they recommend. And that changes everything. The bank advisor recommending their own investment products, the insurance broker earning commission on the policy, the mortgage advisor with preferred lenders, the financial influencer with affiliate deals. This obviously doesn't automatically make the advice wrong. It makes it conflicted. And conflicted advice, even from a genuinely well-meaning people, is systematically biased towards whatever generates the most commission for them, not whatever is best for you. Before acting on any financial recommendation, ask them one question. How does the person giving this advice make money from it? If the answer is unclear or they are reluctant to tell you, that's your signal to get a second opinion from someone whose fee you pay directly, not someone paid by the product they're selling you. Debt is a tool. Most people just use it wrong. The most financially sophisticated people in the world are almost always in debt on purpose. There are two completely different kinds of debt, and most people treat them as the same thing. Bad debt, borrowing to buy things that lose value or generate no return. Consumer credit, car loans for depreciating vehicles, holidays on credit cards. And there's good debt, borrowing to acquire assets that generate more than the debt costs. A property that rents for more than the mortgage, a business investment that returns 10 times the interest. The wealthy use debt as a leverage to control more productive assets than cash alone would allow. The financially struggling use debt to consume now and pay more later. The debt itself isn't the problem. What you pointed at is. Passive income is real, but it requires active wealth first. Passive income is one of the most misunderstood concepts in personal finance, and the misunderstanding keeps people chasing the wrong thing. Passive income exists, it's true. Dividends, rental income, interest, royalties, these are real income streams that require little ongoing work once established. The part nobody mentions is that they all require significant capital or assets to generate meaningful amounts. A portfolio generating 5% annually needs to be $500,000 to produce $25,000 a year. A rental property generating income requires the deposit, the purchase, the maintenance, all costs. So passive income is the reward for having already built wealth, not the method for building it. So using passive income as your primary wealth building strategy, starting from zero, means waiting sometimes even 50 years for the compounding to matter. Build active income first, aggressively, then convert it into assets that generate passive income, in that order. Cash flow is more important than profit. More businesses and people go broke while being technically profitable than most people realize. Profit is what's left after you subtract costs from the revenue. Cash flow is whether the money is actually in your account when bills are due. Those are not the same things. A business can be profitable on paper and still go bankrupt if clients pay late or if a big invoice is outstanding, if expenses hit before revenue arrives. The same applies to individuals. You can have assets worth hundreds of thousands of dollars and still be unable to pay rent if everything is tied up and illiquid. Profit tells you if the business model works. Cash flow tells you if you survive the month. They both matter. But when they conflict, and they do conflict often, cash flow is the one that ends you if you get it wrong. So know your cash flow always. The 50-30-20 rule is one of the smartest financial frameworks ever made simple. There is one budgeting rule simple enough to remember and powerful enough to actually change your financial life. And most people have never applied it consistently. 50% of your income goes to needs: housing, food, utilities, transport, the non-negotiables. 30% goes to your wants: entertainment, dining out, travel, pleasure, things that make life enjoyable. And 20% goes to savings and investment. Non-negotiable, paid first before anything else. The genius of this framework is the 20%. Most people save what's left after spending, but the rule says save first, then spend what remains. That single inversion, paying yourself before paying everything else, is the difference between building wealth and perpetually almost getting there. It's not complicated. It's not exciting. That's exactly why it works. Having a business changes your real tax rate before you even spend. Employees buy everything with money that's already been taxed. Business owners buy the same things before the tax is calculated. And that difference is enormous. When you're employed, your income is taxed first. Everything you then buy, your phone, your laptop, your transport, your workspace, you buy with what's left after the government takes its share. A business owner running legitimate expenses through a company does it differently. The phone, the laptop, the home office, all the same thing, the relevant travel. These reduce the taxable profit before the tax is calculated. You're buying them at effectively 20 to 40% less, depending on your tax rate. Same purchases, completely different real cost. This isn't a loophole. It's how the tax system is designed. And it's one of the core reasons having a business, even a small one, alongside employment, changes your financial picture significantly. The system rewards business ownership. That's not an accident. Starting investing 10 years later doesn't halve your wealth, it quarters it. The cost of waiting 10 years to start investing is not what most people think. It's far worse. Two people, same income, same monthly investment amount. One starts at 25, the other starts at 35. By retirement age, the person who started at 25 doesn't have twice the wealth of the other one. They have roughly 4 times as much. 10 years of delay, same money invested, 4 times the difference in outcome. That's not intuitive, but that's actually what compound interest actually does over long time frames. The early years are doing disproportionately more work than the later years because they have more time to compound. The second best time to start investing, or anything actually, is always now. But understanding what delayed actually costs, not 10%, not 50%, but potentially 75% of your final outcome, makes now feel considerably more urgent. So start, even with the small amount, the tiny amount. The time in the market is the variable everything else depends on. 12 rules, all of them mechanical. None of them complicated once you see them clearly. Here's the uncomfortable truth underneath all of this. Money isn't hard. It's just systematically undertaught to people who then spend their lives making financial decisions with incomplete information, wondering why the results don't match the effort. Now you have the information. What changes from here isn't your income, your luck, or the economy. It's the decisions you make next, with the rules you actually understand. I'm Alex. This is AlphaDrive, practical frameworks for business and life. If this gave you something useful, subscribe. There's a lot more where this came from.